Respected viewers, have you ever wondered what happens when the world gets swept up in a storm of unrestrained excitement and speculation? We've seen it before. In the late 90s, when the internet was the new frontier, a wave of optimism crashed over Wall Street and the dot-com bubble formed. Businesses with no profits, no proven products, and no clear path to success became the darlings of the market, riding on nothing more than hype and the promise of the future. But what if I told you what we're seeing today in the world of artificial intelligence is far more dangerous? The AI bubble is shaping up to be far worse than anything we experienced during the dot-com days. And the risks, the consequences, they're not only deeper but much more perilous. You see, the dot-com bubble was born from excitement about the internet, a tool that, though revolutionary, had no clear use case in the beginning. Today, with AI, we're seeing a similar pattern but magnified 100 times. This time, it's not just a new tool. It's the promise of something that feels like it can change the entire fabric of reality itself. And this isn't some speculative whim. It's driven by the kind of fervor that will lead many investors to the edge of an abyss if they're not careful. There's a sense of now or never as people push their money into what is considered the next big thing. But let me ask you, what is the true value of something if it hasn't been proven to work on the ground? Imagine, if you will, a time when people put their faith in new technologies, in the shiny promises of the future, without realizing that those promises were empty. The same thing is happening today. AI, while a revolutionary advancement, is still in its infancy. Yet we are witnessing investors, and even entire nations, rushing to place their bets on a future that hasn't even materialized yet. The problem is, when the floodgates open and the tide of speculation swells, it often carries with it the type of capital that is reckless and uninformed. In the dot-com bubble, many companies were valued at astronomical figures without any earnings or clear path to profit. In the AI space today, we're seeing a similar pattern. But there's a key difference. The stakes are much higher, and the technology, while promising, is still unproven. What we're witnessing today is a trap, a financial abyss that, if entered blindly, could leave a trail of destruction in its wake. The excitement is real, but so are the risks. The AI bubble may seem like an investment opportunity too big to ignore, but if history has taught us anything, it's this: never trust a speculative boom that isn't grounded in actual, sustainable progress. Now, I want you to think about something with me for a moment. When the dot-com bubble burst in the early 2000s, many companies that had skyrocketed in value came crashing down, leaving behind rubble. Entire industries were set back by years of stagnation. Some of the greatest ideas in the world got lost in the collapse. But here's the thing. The dot-com bubble was a bubble of the internet, which eventually proved its worth in ways we could never have imagined back then. But AI, it's different. The stakes are higher. The technology is more complex, and the promises we're being sold today are broader and more intoxicating. The reality is that for many AI companies, the road to profitability is murky at best. And worse, some are built on the belief that artificial intelligence will solve every problem, from healthcare to transportation, from education to finance. It's too much, too fast. The question is, how long will this wave of speculation continue before the tide pulls back, revealing the cracks underneath? Now, think about this for a moment. When you hear artificial intelligence, you might picture robots, self-driving cars, or systems that think for themselves. But the reality is much different. We're talking about algorithms and data. Yes, AI is powerful, and yes, it holds immense potential. But it's not magic. It's not going to suddenly solve all the problems that many investors believe it will. Not all AI companies will succeed. Many will fade into oblivion. And here's the core of it. That's the danger. As with the dot-com era, there will be plenty of casualties. There will be startups and tech giants alike that fall victim to their own inflated promises, and those who believed in them will suffer. But that's not the worst part. The worst part is that when the dust settles, the real innovators, the ones with the vision, the long-term commitment, and the focus on building something that works, will be left standing. But that doesn't come without pain. As we go forward in this series, I want you to pay attention. The lessons we're going to discuss are not just about AI or bubbles. They're about understanding the cycle of innovation, investment, and the crucial elements of patience, discernment, and long-term vision. It's tempting to follow the crowd when everyone else is rushing toward the bright, shiny future. It's easy to get swept up in the excitement. But if you want to be part of the true winners in this game, you have to be grounded. You have to be able to distinguish between what's real and what's inflated. In the next part of this video, we'll dive deeper into the mechanics of the AI bubble and look at why it's even more dangerous than the dot-com bubble. We'll talk about the lessons you need to learn and how you can protect your wealth from being swept away in the rush. Stay with me, and let's continue this journey together. As we continue down this path, let's take a closer look at the mechanics behind the AI bubble and why it's far more dangerous than what we saw during the dot-com era. You see, in the dot-com boom, the hype was about the internet, an innovation that, while groundbreaking, was something we could all understand. We saw websites emerging, online stores popping up, and early attempts at digital communication. But the promise was tangible. We all knew what the internet was, even if we didn't fully understand its potential. And yes, there were some truly wild valuations, but there were also companies like Amazon and Google that survived the crash and went on to change the world. But AI is different. It's a black box for many people. It's not something everyone can wrap their heads around. At its core, artificial intelligence is the ability of machines to perform tasks that would typically require human intelligence. Sounds simple, right? But when you dig deeper, you realize that AI encompasses an incredibly complex range of technologies, from machine learning and neural networks to deep learning and natural language processing. And that's just the tip of the iceberg. The challenge with AI is that while it's extraordinarily promising, it's also deeply uncertain. And here lies the first key reason why the AI bubble is so much more dangerous than the dot-com bubble. The technology is still evolving, and it's far from perfect. With the internet, we could see the building blocks taking shape: email, websites, and e-commerce. The direction was clear. AI, however, is evolving at breakneck speed, with companies claiming they've developed products and solutions that no one fully understands yet. The promises are enormous. AI will cure diseases. AI will end traffic jams. AI will solve world hunger. It's also seductive, and investors are eating it up. But here's the catch: it's a mirage. While AI has already started to make incredible strides in certain industries, we are nowhere near the utopia that some have promised. The majority of AI companies today are in the early stages of development. Many of them are still struggling to prove that they can turn their ideas into reality. And yet, the market is treating these companies as if they've already changed the world. Just like in the dot-com era, the vast majority of AI companies won't survive. You see, in any bubble, most of the companies that are riding the wave aren't building something fundamentally valuable. They're riding the hype train, hoping that they'll get bought out before the crash happens. But when the bubble bursts, only the companies with real value, the ones that have a concrete, sustainable business model, will survive. That's why the AI bubble is so much worse. The dot-com companies had something tangible: a website, a product, a service. Many of them failed, but some eventually found their place in the world. With AI, however, the technology is so complex and still in its infancy that it's difficult to separate the signal from the noise. This complexity is what makes AI so difficult to evaluate. How do you assess the value of a company claiming to revolutionize healthcare with machine learning when no one really knows how close they are to delivering on that promise? How do you value an AI startup that's working on a project that could take years to develop, if it even works at all? This uncertainty breeds speculative behavior, and that's where things get dangerous. Investors today are rushing to pour money into AI startups, not because they understand the technology or its potential, but because they fear being left behind. Everyone wants to be in on the next big thing, but in reality, many of these companies won't even exist 5 years from now. The reason is simple: the promises of AI are often inflated and the risks are downplayed. Look at what happened during the dot-com bubble. People were buying stocks in companies with little more than a web page and a big idea. It didn't matter if the company had a solid revenue model or any kind of sustainable growth strategy. What mattered was being part of the next big thing. And when the bubble burst, trillions of dollars in value evaporated. We're heading toward a similar scenario with AI, but the stakes are even higher. You see, in the case of the internet, we could at least see a path to profitability for many companies. E-commerce, advertising, and digital communication were all ideas that had clear revenue models. But in the AI world, many companies are still chasing the dream of building something transformative without any concrete proof of how they'll make money. And without that proof, many of them will eventually collapse under the weight of their own hype. In fact, it's not just the uncertainty of the technology itself that makes AI such a dangerous bubble. It's also the sheer speed at which the hype has accelerated. Think about it, just a few years ago, AI was a niche technology. But now it's everywhere. Every company, from startups to tech giants, is jumping on the AI bandwagon. And because everyone is rushing to invest in AI, the valuations of these companies have become completely disconnected from reality. To make matters worse, the allure of AI isn't just confined to the world of tech investors. It's reaching the broader public too. People see the flashy headlines, the big promises, and the get-rich-quick schemes surrounding AI, and they want a piece of the action. This fuels an even bigger bubble as more and more money pours into a space that's already overvalued. But just like the dot-com bubble, this frenzy won't last forever. At some point, reality will set in. The companies that have been riding the hype will falter, and the true innovators, the ones who are building real, sustainable businesses, will be the ones left standing. So what's the takeaway here? The AI bubble is a dangerous game, and if you don't understand the risks, you're putting yourself in a position to lose. In the next part of this video, we'll dive deeper into the consequences of the AI bubble and how you can protect yourself from getting caught up in the rush. As we continue to examine the AI bubble, let's take a deeper look at how to navigate these waters and avoid getting caught up in the speculative frenzy. Because the truth is, if you're not careful, you could lose a significant amount of money, just like what happened in the dot-com bust. First, it's essential to recognize that AI is an extraordinary technology, and its long-term potential is undeniable. We're already seeing breakthroughs in areas like healthcare, autonomous vehicles, and financial services. But the key word here is long-term. If you're thinking about investing in AI, you need to keep your eyes on the horizon, not just the next few months or years. The issue is most investors are focused on the short-term hype, the rapid acceleration of AI's capabilities, the impressive headlines about AI's potential, and the fear of missing out on the next big thing. This causes people to rush into investments without understanding the underlying fundamentals. This rush, this frenzy, is what sets the stage for another bubble. It's easy to get swept up in the excitement. After all, AI sounds like the future, and who doesn't want to be part of the future? But remember, the future doesn't always unfold the way we think it will. Just as during the dot-com era, many companies today are still in the experimental phase. They're figuring things out as they go, and they haven't yet proven that their products will succeed on a large scale. They have big ideas, but the execution is often uncertain. So, even though they may have the hype and the glamour, they lack the proven track record and sustainable business models that could generate real, long-term value. Let me tell you a little story. In the 1990s, there were companies like Pets.com, which were the darlings of the dot-com boom. Their websites were flashy, their marketing was everywhere, and investors were falling all over themselves to get in. But when the hype died down, the reality set in. There was no business model to support the valuation. There were no real customers, and there was no path to profitability. Eventually, Pets.com went bankrupt, and investors lost billions of dollars. Sound familiar? In many ways, the AI space is following the same trajectory. We have AI companies promising the moon. But what happens when the hype dies down? What happens when the reality of the technology hits and we start to see which companies are actually making meaningful progress and which ones are simply riding the buzz? Many of these companies won't survive. There will be casualties, and there will be significant losses. So if you're thinking about investing in AI, it's crucial to separate the wheat from the chaff. You need to focus on companies that have a solid business model, a proven track record, and a clear path to profitability. Don't get swept up in the excitement of the latest AI product that promises to change the world. Instead, look for companies that are taking a methodical, measured approach to developing AI. One of the things I always stress is that as patience and discipline are the keys to successful investing. You have to be willing to ignore the short-term noise and focus on the long-term fundamentals. Just because something is trendy doesn't mean it's a good investment. In fact, trends are often the enemies of good investing. Let me give you an example. Think back to the early 2000s. The internet was booming, and everyone was talking about the next big thing. But while the market was going crazy, some investors, the ones who had the patience to look beyond the hype, were quietly building wealth by focusing on solid, established companies. They didn't chase the trends. Instead, they invested in companies that had real businesses, real revenue, and real potential. When the dot-com bubble burst, those investors who had remained patient were left standing. They didn't get caught up in the frenzy, and they didn't lose their money when the bubble popped. Instead, they were ready to seize the opportunities that came in the aftermath. The same principle applies to AI today. Don't chase the trends. Don't rush to invest in the latest AI startup just because it's being hyped. Focus on the companies that have real sustainable business models. Look for companies that are using AI to solve real-world problems that are difficult to solve but have a clear path to success. AI will change the world, but that doesn't mean every company working on AI will be successful. There will be failures and there will be losses. But if you focus on the right companies, the ones that are grounded in reality and have a solid plan, you can ride the wave of AI without falling victim to the bubble. And here's the important part, ours investing in AI or any emerging technology is a marathon, not a sprint. Don't expect to get rich overnight. Real wealth is built over time through steady, disciplined investments in companies that have the potential to deliver consistent long-term returns. So, what can we learn from the dot-com era that applies to the AI bubble? The most important lesson is this: don't fall for the hype. Hype leads to irrational exuberance, and irrational exuberance leads to bubbles. Focus on the fundamentals. Stay patient and wait for the companies that are truly building something valuable to emerge. In the next part, we'll dive deeper into the importance of understanding the technology behind AI and why it's so critical to make informed investment decisions. Because when it comes to investing, knowledge is power. You can't afford to invest in something you don't understand. You need to have a deep understanding of the technology, the market, and the companies that are involved in it. 2. Now that we've established the risks of getting caught in the AI bubble and why it's so crucial to avoid the hype, let's talk about something that often gets overlooked: understanding the technology behind the companies you're investing in. This is the area where most people miss the mark. You see, AI isn't just a buzzword. It's a rapidly evolving field, and its applications span across many different industries, from healthcare to finance, education to transportation. But the fact that AI is such a broad field means there's a lot of noise, and a lot of investors jump in without truly understanding what's happening behind the scenes. They see a flashy product or hear a compelling pitch, and they assume that all AI companies are the same. But they're not. Just like in any field, there are leaders, there are followers, and there are also those who are simply capitalizing on a trend. The question is, how do you tell the difference? How do you separate the companies that are genuinely innovating from the ones that are simply riding the wave of a fad? One of the most important aspects of investing in AI is understanding the WAS technology. What's the core of the product? How does it actually work? What are the underlying algorithms and models that power it? AI is complex, and if you don't understand how the technology works, how can you evaluate the companies that are building it? Think of it like investing in a car company. If you don't understand how cars are built, how engines work, or how different car models meet the needs of the market, you're going to have a difficult time determining which companies are worth investing in. Sure, the car market might be booming, but that doesn't mean every car company is built to last. Some might have great marketing, flashy ads, and promise you a future of autonomous vehicles, but if their cars aren't safe or practical, their stock is likely to crash. The same holds true for AI. Some companies might have big promises, an AI that can revolutionize healthcare, or an algorithm that can predict the stock market. But if the technology behind those promises is shaky, those companies are destined to fail. To make informed investment decisions, you need to dive deep into the tech. Ask questions like, what kind of AI are they using? Is it machine learning, natural language processing, or something else? Or how robust is the data they're working with? After all, AI is only as good as the data it's trained on. Are they solving a real-world problem, or is it just a solution looking for a problem? Understanding the answers to these questions can help you determine whether a company is genuinely pushing the boundaries of technology or simply capitalizing on the AI trend without much substance. Here's where the dot-com era provides another crucial lesson. Back then, many internet companies were operating in the same way. They had websites, they had cool tech, but they didn't have real, sustainable business models. They were selling a vision, not a product. Take Webvan, for instance. The company promised to revolutionize grocery delivery through the internet. It had a flashy website, venture capital money, and a lot of hype, but it didn't have the infrastructure to deliver on its promises. It lacked a clear understanding of how to build a scalable business. They didn't have a sustainable product. And so, Webvan and many others like it failed. The same can happen in AI. Just because a company has AI technology doesn't mean it's going to succeed. The key to success isn't just having technology, it's having the right technology built in a way that solves real-world problems and has a clear path to profitability. One of the best ways to evaluate an AI company is by looking at its AR's use case. How is the company applying AI to solve an existing problem? Is the solution scalable? Is it addressing a major market need, or is it simply an interesting concept? Let me give you an example. Consider the healthcare industry. AI has tremendous potential to revolutionize healthcare, from drug discovery to diagnostic tools. Companies that are focused on using AI to solve these pressing problems are likely to offer more sustainable long-term returns. Why? Because they're not just jumping on a bandwagon, they're solving real, high-impact problems that affect people's lives. These companies are addressing market inefficiencies, creating value, and improving outcomes in ways that are meaningful. But if an AI company is promising to predict the weather better than existing models, but they haven't proven the accuracy or reliability of their technology, you should be cautious. It sounds nice, but is it realistic? Is it scalable? Is it truly going to add value? Evaluating AI investments requires careful consideration of real-world applications. It's not enough to be impressed by fancy algorithms or catchy slogans. The technology must solve a tangible problem. It must create value in the real world. And here's where patience becomes crucial. While AI has enormous potential, it's also a long game. It's not about jumping into the market and making quick gains. As investors, we must remember that the real wealth comes from identifying companies with solid, sustainable products, and that takes time. Now, I'm not saying that every AI company is going to fail or that there's no money to be made in AI. What I am saying is that it's important to be a selectiver. You need to dig deeper. You need to evaluate not only the product and technology, but also the business model, the team, and the market demand. Does the company have a clear path to profitability? Are they building a business that will stand the test of time? Now that we've delved into the importance of understanding the technology behind AI companies and the need to be discerning in your investment choices, let's talk about the broader economic forces at play. As with any major technological shift, AI is not just about algorithms and data. It's about how these technologies intersect with the larger market trends, policy changes, and the global economy. One of the most overlooked aspects of investing in emerging technologies is understanding the macro environment. Technology doesn't exist in a vacuum. It's shaped by government regulations, global trade policies, economic cycles, and even societal attitudes. AI, for all its potential, is not immune to these factors. In fact, it's quite the opposite. The AI market is inextricably linked to broader economic forces that will either propel it forward or hinder its growth. Take a moment to reflect on the dot-com bubble. During that period, investors were fixated on the internet. They were blinded by the growth potential of the web and the idea that this new technology would change everything. What many overlooked, however, was that the internet was still very young. The infrastructure wasn't there yet. The market wasn't mature. And while the internet eventually grew into the massive force we see today, the early days were turbulent. This is where the AI bubble could be even more dangerous. Unlike the internet, AI is still in its infancy, but it's being treated like a fully mature technology by many investors. The reality is that AI is incredibly complex. It's not just a piece of software or hardware. It requires substantial infrastructure, data, and regulation to scale effectively. And like any technology, AI will face regulatory hurdles as governments around the world try to figure out how to control and manage its applications. Consider the growing concerns around AI ethics. As AI systems begin to play a larger role in decision-making, from hiring practices to financial advising, healthcare diagnostics, and even military applications, society is beginning to recognize the importance of building AI in a responsible way. These discussions are not just theoretical. They have real-world implications for how AI will be regulated and deployed. For example, will AI be used to perpetuate bias? How will governments ensure that these systems are transparent and ethical? As an investor, these questions aren't just philosophical. They are practical concerns that will affect the companies you're considering investing in. If the regulatory landscape becomes more restrictive, some AI companies might find themselves stifled, unable to deploy their technology at scale. And that could have a serious impact on their profitability and, by extension, their stock price. But regulations are just one side of the coin. The broader global economy also plays a huge role in determining how successful AI will be. For instance, AI systems rely on massive amounts of data to function effectively. This data is often controlled by large tech giants, and geopolitical tensions can significantly affect the flow of data across borders. For example, if certain countries decide to limit or control the access to data from their population, AI companies in those regions might find themselves at a serious disadvantage. At the same time, the availability of capital is a crucial factor in the development of AI technologies. As global financial markets fluctuate, so too does the availability of investment dollars for AI startups. In times of economic uncertainty, venture capitalists might become more risk-averse, which could stifle innovation and slow down the progress of emerging technologies. And while the markets might seem flush with money today, remember that these things change. Investors in the AI space need to be keenly aware of how these macroeconomic factors will influence the future of AI. If you're simply investing in AI because of the hype without considering the broader economic landscape, you're missing a critical part of the puzzle. To make smart decisions, you need to understand how AI companies will navigate the regulatory and economic hurdles that lie ahead. And while the technology itself may seem like the most important piece of the puzzle, in reality, it's often the companies that can navigate these external factors, the ones that can adjust to economic shifts, embrace regulatory changes, and build in a sustainable, ethical way, that will emerge as the true winners. In the next part, we'll talk about how to identify companies that are truly prepared to succeed. In the AI space, those that have a sustainable competitive advantage, a proven business model, and the ability to adapt to the changing world. Because in the end, as much as technology and market trends matter, it's the companies with the right vision, leadership, and strategy that will thrive. We've explored the dangers of the AI bubble, the complexities of the technology itself, and the macroeconomic factors that can shape its future. Now, let's focus on how to identify the companies that will weather the storm and emerge as true leaders in the AI revolution. This is where the real work begins. In investing, there's no such thing as a sure thing. There are no guarantees, but there are ways to improve your odds to make smarter, more informed decisions. Just like in any market, identifying quality companies requires understanding their fundamentals, their strategy, and their vision. First and foremost, let's talk about sustainability. When you're looking at an AI company, you have to ask yourself, is this company built to last? Many of the companies driving the AI hype are startups or companies that have yet to prove they can scale their technology effectively. In the dot-com era, many of the most hyped companies had little more than a website and a dream. They lacked profitability, had no clear business model, and most importantly, their products or services weren't fully developed. They were just ideas. Today, we see the same thing with AI. A lot of the companies that are gaining media attention have promising technology, but that's just the beginning. Technology doesn't automatically translate to profitability. A good business model is what will make or break these companies. So, when you're considering investing in an AI company, dig into their business model. Do they have a clear path to profitability? How will they monetize their technology? Are they relying on venture capital to fund their operations indefinitely, or do they have a plan to generate sustainable cash flow in the long term? Look for companies that can demonstrate that they have a solid revenue model, ideally one that doesn't rely solely on speculative hype. Another key factor to look at is the quality of leadership. The companies that succeed in any industry, but especially in a rapidly evolving field like AI, are those with visionary leaders who can balance innovation with discipline. Leaders who have experience in scaling businesses, who understand the complexities of the technology, and who can adapt to the ever-changing landscape of the market. It's not just about being an inventor, it's about being a strategist. In the dot-com bubble, many companies were led by individuals who were more focused on raising capital and riding the hype than on building something that would stand the test of time. The leaders of today's AI companies must be more grounded. They need to have a strong vision for the future, but they also need to be able to execute on that vision with discipline and patience. The ability to navigate the challenges of regulation, competition, and global economic factors will be the true test of leadership in the AI space. Now let's talk about competition. One thing we know for sure is that AI is not a winner-takes-all market. It's not like the internet where a single company, say Google or Facebook, could dominate the space. The AI landscape is more fragmented, and there are likely to be several winners. This creates an opportunity for investors to be selective about the companies they back. Think diversification, but also think about focused bets on the companies that have the best competitive edge. So what constitutes a competitive edge in AI? There are a few factors to keep in mind. Data is the lifeblood of AI. The companies that have access to the most valuable, high-quality data will have a massive advantage. This is why companies like Google, Amazon, and Microsoft are so well positioned in the AI race. They already have vast data sets that they can leverage to improve their AI systems. But don't just focus on the big players. Smaller companies that have proprietary data or unique partnerships can also be in a strong position to succeed. Another crucial element of competition is AI talent. The companies that can attract and retain the best minds in the industry will have a competitive edge. AI is not just about algorithms, it's about having the right people who can innovate and drive the technology forward. This is where investing in companies that have established research partnerships with universities or talent acquisition strategies can be a smart move. Finally, let's talk about timing. The truth is AI is still in its early stages. Many of the most exciting developments are yet to come, and the technology is evolving at an incredibly rapid pace. This creates a unique opportunity for investors who can be patient and wait for the right moment to enter. But timing is also about avoiding the hype. The AI bubble we're seeing today is fueled by speculation and excitement, but the real value in AI will come from companies that build their technology with real-world applications in mind, not just the next big thing. In the next part, we'll explore how to manage risk in your AI investments. Every investor knows that no investment is without risk, but there are ways to protect yourself from the downside while still capitalizing on the upside. I'll share some strategies that will help you navigate the volatility of the AI market and make smarter, more informed decisions. As we near the end of this journey, let's pause for a moment and reflect on everything we've covered. We've talked about the potential and the pitfalls of the AI bubble, how it mirrors the dot-com era, and how to approach this fast-moving, highly speculative market with caution and clarity. But at the core of all this, one truth stands tall: patience, discipline, and integrity will guide you through the noise. AI, like any disruptive technology, promises enormous potential. But history has shown us that it's not the technology itself that guarantees success. It's the vision, the execution, and the long-term mindset that separate the winners from the losers. You see, the key to investing in any market, whether it's tech, real estate, or AI, is not to get swept up in the excitement of the moment. It's easy to get caught in the frenzy of a bubble, to let greed and speculation cloud your judgment. But as a true success in investing comes from looking beyond the hype, from understanding what's real and what's illusion. It's about keeping your eyes on the fundamentals and trusting that the market will reward those who stay grounded. Remember, as the greatest investors in history didn't get to where they are by following trends or chasing after the next big thing. They got there by being patient, by making thoughtful, calculated decisions, and by staying true to their principles. So, as you look at the AI space or any other market, I urge you to ask yourself the tough questions. Is the company you're looking at built to last? Does it have the leadership, the strategy, and the competitive edge to weather the storms ahead? As we've discussed, not all AI companies will succeed. Many will falter under the weight of their promises. But those that can adapt, innovate, and remain disciplined will thrive. And when they do, they'll not only change the world with their technology, but they'll also reward those who had the foresight to invest in them. So, as you step forward on your investment journey, don't be fooled by the siren call of speculative bubbles. Stay true to your principles. Invest in companies that are not just riding the hype wave, but are building something real, something that can stand the test of time. Focus on the long term, not the quick win. And above all, remember that the best way to weather any market storm is by staying grounded in reality. The road ahead will be filled with ups and downs, twists and turns. But if you keep your vision clear, your mind focused, and your strategy grounded, you'll not only survive the volatility, you'll thrive in it. This is how true wealth is built, not on the waves of speculation, but on the bedrock of patience and discipline and integrity. The future of AI is uncertain, yes, but for those who invest wisely, with clarity and purpose, the rewards will be immense. The only thing that stands between you and that future is the wisdom to make the right decisions today. I hope you now understand that the AI bubble is not just another market trend. It's a lesson in patience, in long-term vision, and in the power of fundamental investing. The question isn't, will AI change the world? It already is. The question is will you be ready for the opportunities it brings? Stay wise, stay disciplined, and remember, the best investors know that the future doesn't belong to the fastest moving investors, but to those who take the long road with clear eyes and a steady hand. Thank you for joining me today. Stay focused, stay grounded, and as always, keep investing in what matters.